All right. Good morning, agents. This is Kevin Lauren. I'm the Director of Training and Marketing here at Alta Realty Group. And today we're going to be joined by Jordan Phillips, and he's going to go over 1031 exchanges. So this is a really important thing for all realtors to understand. And that way you can give this valuable information to your clients. So looking forward to today's presentation by Jordan. He's, of course, visited us many times. But before we get into today's presentation, I'm going to bring Bill Seitz, corporate broker of Alta, on the line. Good morning, Bill. How are we doing today?
Good morning, Kevin. Good morning, Alta. We're doing well. It's finally feels like a winter day here today.
I bet. Cold, huh?
It's cold. It's overcast. It looks like it's going to be raining for the next couple of days. So it's a good time to get things done on the computer that maybe you're procrastinating or
Oh, yeah.
not going to feel bad about getting that stuff done.
Yeah.
For myself, I've got some more compliance to finish off today for our quarterly report. So I will be fine sitting here looking at the gray clouds outside, knowing that this is a perfect day to do it.
Absolutely. Spot on, Bill.
Yeah. So yeah, excited to have Jordan back on. 1031 exchanges are probably something that a lot of us aren't too familiar with. But I think nowadays we see a lot of investors either moving up into more units or even people leaving the state of California and wanting to use a 1031 exchange to facilitate a new purchase or just the overall tax implications. So I know Jordan will bring us a very broad and good summary to those things. I've actually referred a personal client of mine to Jordan, so I know that he does a good job at what he does. But before we get going, Kevin, I always want to recognize a couple of new agents that have signed up with Alta. Paul Coniglari, I think that's an Italian last name. So sorry, Paul, if I couldn't roll that out perfectly. Eva Mariscal, Martha Medrano, and Reza Emma Ghiazzi. Welcome to Alta. This is our weekly meeting. So hopefully you guys find it useful, find it productive, and we've got a lot of quick things that we're going to pack into this training before we button it up. On the Broker Tuesday tip, if everybody got that yesterday, this one's really important. Just want to run through this really quick, and then we'll get to Debbie and then get Jordan on his way. But the insurance issue, as we all know, insurance in California is becoming more difficult. We saw with the fires and even preceding the fires. I bet everybody at this point knows somebody who's had their policy either canceled or threatened to be canceled. I was going through some insurance stuff yesterday, and in that Broker Tuesday tip, if I don't know if you can even pull it up, Kevin, while I'm talking, but
Yeah, sure.
there's some really good advice on what happens if you get a non-renewal notice and what actions you can take if you do receive that. How to file complaint with the commissioner, the insurance commissioner, if that does happen to you. And also there's a really good list of all the, basically local agents and companies and brokers that are issuing insurance in the state of California. So it's a pretty big list. All the big players are on there. So that in and of itself is super handy to have at your fingertips. And then lastly, it goes through the California Fair Plan and gives an overview of what that is. And, that's kind of maybe a last option for coverage, the Fair Plan. And there are some limitations to it and, and this and that. But if you're not familiar with what the California Fair Plan is, there is a nice overview of that. So it was 10 tips on basically finding residential insurance. And yeah, Kevin's pulled it up there. The on number 4 was the residential insurance company contact list. So it's even linked into that little, kind of, Tuesday tip newsletter style thing. So this is very, very resourceful. I would save this somewhere, or at least save the link to the insurance.california.gov, because now more than ever as agents. And, now that we all know too, they've incorporated the insurance contingency into the contract. Insurance is now something you got to get on the ball straight away. You got to, once you get into contract, you've got to get that started, because the last thing that you want to have happen is get to the finish line and now you're waiting on a policy and it's becoming, and you're hitting, dead ends on either side of every phone call and going like, oh, what am I going to do? We've got to get this closed. So anyways, that one's super important. Keep that handy, and let's get Debbie on for a quick mortgage update.
All right, sounds good. Let me switch screens here. Yeah, that's so huge. You do not want to run into that issue at the end of a deal. It's a deal killer right there. So good tip today. Appreciate that, Bill. So let's bring on Debbie Saccone from Clearview Mortgage. Clearview, of course, is our mortgage arm of our company, and Debbie is consummate professional and really a huge resource for us. So Debbie, good morning. How are you today?
Good morning. I am fantastic as usual. And I'm just going to give a quick little excerpt of interest rates. I checked rates for a client yesterday. So as far as today, they are slightly higher. And the 10-year Treasury note did go up a little bit. This US 10-year Treasury index is a very good index to watch on a regular basis if you are interested to know what interest rates are going to be doing. And if you look at it, it has a green arrow and it's green and it's going up. That means rates are, could go up today. I'm not going to say probably, but if that number keeps rising, then we will have a rate change today at some point. If that arrow is red going down and the number is red next to it, then that means that, if you continue to see, well, it just went up again. If you continue to see that red arrow and that number next to it going down, with a larger number, then we could get a revision in interest rates downward. So that being said, rates are still hovering. Actually, we can get below 7% on a 30-year conventional rate. But people are still wondering, well, how can I get a lower rate? You know what? There's great ways to do it. There is a permanent buy down where, let's say that the interest rate without a buy down, no origination fee at all, is 6.875%. Okay. Of course, if you want a lower interest rate, it's going to cost some money. That is a buy down. That's a permanent buy down. You want to permanently buy that rate down. So in a situation where I'm using a $560,000 purchase price and a loan amount of $336,000, so this buyer is putting 40% down. The cost to buy the rate down to, let's say, 6.5% is only $4,600 origination fee. That's not too bad. And you can even maybe ask for the seller to pay for that. If you want to buy it down to 6% today for that loan amount, it would be around $11,000 cost to buy that rate down to 6%. There's another way too, and that's a temporary buy down, and it's a seller paid temporary buy down. So the seller must pay for this. And that means that, you as a realtor are, have the ability to ask the seller to cover $10,000 or however whatever the cost of the temporary buy down is for that buyer. The difference between the temporary buy down and the permanent buy down is a couple things. You on the permanent buy down, you can actually qualify for that interest rate that you buy it down to. So if you're buying that rate down to 6%, you can qualify at the 6% interest rate. But the temporary buy down, if you are, your first year, because it is only temporary, I'll give you an example of one. right now with that loan amount, I'm using a 6.875% regular interest rate, but the first year, the rate is 4.875%. The second year, the rate is 5.875%. And then the third through the 30th year, it will be 6.875%. We still have to qualify the buyer at 6.875%. But they get a break the first couple of years on the 2-1 buy down. So the temporary buy down will just buy the rate down for the first year and the second year. And, in hopes that interest rates will be going down in the next 2 to 3 years, and then they can refinance. Let's say that the rates go down in 1 year. And so 1 year from now, they can get 4.875%. And I know I'll wake up in just a few minutes, but anyway, that's a good dream. 4.875%. And what happens to the money that bought that rate down temporarily in the first or second year? That actually gets refunded to the buyer when they refinance in the form of a principal reduction. So when we order the payoff, I know I'm really talking fast on this, so definitely call me if you want more information. But when we order the payoff demand, it's going to reflect on that as the balance showing less than what you thought you had to pay off. So there's all kinds of intricacies to the temporary buy down and the permanent buy down, but just know that there is a way that your buyer can get a lower interest rate than today's interest rates, and hopefully, possibly not on their dime. You can always ask the seller to cover either way. So anyway, if you have more questions, don't hesitate to call me. I love talking to people and I love teaching you and helping you along the way.
Very, very cool stuff, Debbie. I mean, this is the kind of thing that could save a deal, can create a deal. And if you're armed with this kind of information, and you don't have to know it all. You just have to know a tiny bit enough to be dangerous, and then connect your buyers with Debbie, and she does all the magic. Right, Bill?
Yeah, absolutely. Debbie, you did an outstanding job explaining that. And, for us that are pretty fluent in finance, she literally nailed it. And if you're not, that's okay. Give Debbie a call and she'll spend a few more moments with you. But those are two really good mechanisms for, a short-term solution with the higher interest rate market. So.
Yeah, well done, Debbie.
Oh, well, thank you. I hope you guys have a great week. Oh, I'm going to listen to the 1031 exchange info too. That's pretty cool stuff.
It's very cool, and we can all learn something, right?
Yeah.
Okay, so we're going to shift gears. We're going to bring on Jordan Phillips. Jordan, are you able to talk?
I am. Can you hear me?
Clear as a bell.
Okay, perfect. Well, hey, thanks for having me on today. Do you mind if I share my screen?
Yes, I was just going to say that. You can steal the screen sharing and away you go. Perfect.
Okay, you guys can see that? Perfect. All right, well, hi everyone, I'm Jordan Phillips. I'm with IPX 1031. So what I want to do today is basically just go over the 1031 exchange process, go over the key guidelines, what you need to know, if your clients are doing a 1031 exchange, and also kind of go over what we're seeing in the marketplace today. So there's my full contact information. Feel free, save it. After this call is over, obviously there's going to be a lot of questions that may or may not pop up. So that's really all I do all day. Is if I'm not giving presentations, I'm on the phone answering calls and emails. So anything that you guys need, that's what I'm here for. So to start from the beginning, what is a 1031 exchange? So in simple terms, a 1031 exchange is a section of the tax code that allows you to defer paying your capital gains taxes whenever you sell investment or business real estate. And I get asked all the time, hey, 1031 exchanges, are they going to be going away or staying in the tax code? Because really every year, there's always threats that 1031 exchanges will be either, eliminated or reduced. And going back, 1031 exchanges in some form or fashion have been in the tax code since 1921. So 1031 exchanges initially started as a way for basically farmers to exchange real estate without paying taxes. Let's say, for example, I owned, you know, a piece of property that I grew strawberries on, and Kevin owned a corn patch, and I was tired of strawberries, and Kevin was tired of corn. We could swap those properties and not pay any capital gains taxes. So that's how 1031 exchanges initially started back in the 1920s, and they've evolved into basically one of the most powerful wealth preservation tools in the tax code. But it is, kind of scary in my job is, all I do is, facilitate 1031 exchanges. And every year there's always the threat, hey, your 1031 exchange is going to be in the tax code. So as of right now, there are no imminent threats that 1031 exchanges will be reduced or eliminated. Um, so if you have clients thinking about or doing exchanges, they can rest assured that they'll be able to do their 1031 exchange. And that's good for us, especially here in Southern California, because I like to call Southern California essentially the mecca of 1031 exchange activity. So our company, I'm with IPX 1031. So we're a nationwide company. We have offices all over the country. And about 1/4 of all of our company's business occurs right here in Southern California. And that's for basically two reasons. One, properties here appreciate faster than just about anywhere else in the country. And two, we are subject to the highest taxes of any state in the country. So essentially, if you have a client who's looking to sell their rental property, for example, and cash out and pay their taxes, here are the various taxes that they would be subject to. So at the federal level, on the appreciation, they would be paying, either 15 or 20% based off their taxable income. Most of our clients are going to be in that 20% tax bracket. And the reason being is the gain from the sale of the real estate usually puts them in that higher tax bracket. So right off the top, you're going to be giving 20% of your appreciation to the federal government. State of California, like I mentioned, we have the highest state taxes of anyone in the country by a long shot. So most of our clients are going to be subject to a 13.3% tax rate at the state level. Most of our clients are also going to be subject to what's called the net investment income tax, which is a 3.8% tax. And then all depreciation that was taken on the property or could have been taken is also taxed at a 25% flat rate. So blending all of these rates together, if you do not do a 1031 exchange, you live in California, you're probably looking at a blended tax rate somewhere in the mid, 30s. So that's usually when I get the call and say, oh crap, I just found out I have this huge tax liability. I also heard I can defer paying all those capital gains taxes by doing a 1031 exchange. Tell me a little bit more about what goes in to doing a 1031 exchange. So at the end of the day, there's really only a few major guidelines that you do need to be aware of when doing a 1031 exchange. And the first is, what can you actually sell and buy in a 1031 exchange? So the IRS has this term like kind, which basically means that you have to sell and buy real estate that is deemed like kind to each other. So I get calls from a lot of clients saying, hey, look, I'm selling my single family rental. I heard this term like kind. Does that mean I have to go out and purchase another single family rental in the 1031 exchange? Fortunately, the answer to that is no. So the IRS is a pain in the backside on a lot of things, but on this term like kind, they are very flexible. So basically, what it means is that the IRS doesn't care what type of real estate that you're purchasing. So the only requirement is that you're selling and buying U.S. real estate that is used as either an investment or in the use of a business. So if you wanted to sell your single family rental, go out and buy a duplex or a triplex. Vacant land qualifies for an exchange, commercial real estate. So if they were selling like an office building or industrial, retail, all that qualifies. And then there's also some outside of the box stuff that qualifies as well, like cell towers, billboards, windmills, solar farms, DST interest, so fractionalized interest in real estate. All of that actually qualifies for a 1031 exchange. So just keep in mind, property type doesn't matter, property state doesn't matter, but the property does need to be used as either an investment or in the use of a business in order to qualify. So this broad like kind term really allows for a lot of non-tax benefits when doing a 1031 exchange, right? Like, Bill was mentioning, you have a lot of clients who might be selling in, California and buying, out of state. So I would say probably about a third of our clients are buying out of state. So states like Nevada, Arizona, Texas, Tennessee, Florida. We're seeing a lot of our clients, take their funds and buy in one of those states. So going out of state is very common. Diversifying is pretty common as well. So like if you wanted to sell one property and buy multiple properties, you could do that in a 1031 exchange. The most extreme example I've ever seen of this is I had a client a few years back who was selling his business. And part of the business was a $10 million industrial property. So he calls me up and says, "Hey, look, Jordan, I'm selling my business. I have this $10 million property. I'm retiring, so I don't want to buy another business property, but can I go out and buy rental properties?" The answer to that is yes. So you can sell business real estate and buy investment real estate and vice versa. He says, "Okay, good." And then he says, "Hey, look, I'm selling in California. I don't want to buy investment properties in California. I'm looking primarily for cash flow. Can I go out of state?" The answer to that is yes. So he's planning on buying, or he did buy in Arizona. And then he said, "Hey, look, can I buy multiple properties?" I said, "Yeah, that's fine. You can go from one to multiple. That's totally fine as well." So at the end of the day, he sold one $10 million industrial property and bought 27 single family rentals in Arizona. So I illustrate that not as something that you might see in your day-to-day business, but just kind of a way to illustrate how you can really change property types, property states, diversify your real estate portfolio. On the flip side, you can also use exchanges to consolidate, right? Like a lot of our older clients, might own multiple, rental properties throughout the state of California. And they say, "Hey, look, I'm tired of driving around to, 10 different properties, collecting my rent checks. Can I sell those properties and buy one larger property like an apartment complex?" Answer to that is yes. That's totally fine as well. Um, so utilizing the 1031 exchange for the non-tax benefits is really why we see most of our clients do the exchange, right? They get to, change up their real estate portfolio, and have it better suited to where they're at in their current life. So I always recommend, if you are working with investors, always sit down with them, every couple of months, look over their real estate portfolio, say, "Hey, look, maybe you have a property that isn't cash flowing like you would like or appreciating like you would like. How about we list that property and get you into an asset that's going to perform a little bit better for you?" Couple of other techniques that we see clients take advantage of when it comes to doing a 1031 exchange is for estate planning purposes. So a 1031 exchange is a tax deferral mechanism, meaning if you do a 1031 exchange and let's say 10 years later you sell the property and cash out, at that point, you will pay your capital gains taxes. But what if you never sell the property? So basically, the only way that you can avoid paying your capital gains taxes is to hold the property until you die. So basically, if, like, let's say, for example, I own a piece of investment real estate, I die, my son and daughter inherit the property. At the time they inherit the property, all of my gain that I had in the property gets wiped out upon death. It's what's called a step up in tax basis, meaning that all of my gain that I accrued while I held the property gets wiped out when I pass away. So I hate that that's really the only strategy you could take advantage of for avoiding capital gains taxes, but a lot of our clients do utilize that in what's called swap until you drop. So basically, you exchange, you exchange, you exchange, you never cash out, never pay your taxes, and then you're leaving your heirs with significantly more than you would have if you cashed out within your lifetime. Let's see, we have a chat. Timeframes, yep, that'll be coming up in a slide or two. So another thing as well is that I get questions on are, hey, look, I'm selling my investment property. Can I buy a property that I move into, right? So 1031 exchanges do not include selling or buying your primary residence or your second home or a short-term flip. So like if you bought a property, fixed it up, and then immediately sold it, that also would not qualify for a 1031 exchange. But back in 2008, the IRS actually did come out with guidance on how to buy your future primary residence in a 1031 exchange. So essentially, what the IRS says is that any property that you purchase in a 1031 exchange, it does need to be an investment. But what they say is if you hold that property for 2 years as an investment, so basically what that means in their terms is that in each of those 2 years, you have to rent the property out for 14 days or more. So you buy a property in exchange. Each of the first 2 years, you have to rent the property out for 14 days or more. And if you limit your personal use to 14 days or less in each of those 2 years, after the 2 year period, the IRS does not care how you use that property. So we see this very commonly with some of our older clients who maybe own a piece of investment real estate. They want to buy a property maybe closer to their kids or grandkids, rent it out for a couple of years and then maybe convert that property, into their primary residence or a secondary home. So this, what we call the dream home scenario, actually does come up pretty frequently. So just know if your client wants to buy a primary residence in a 1031 exchange, they can, but they have to wait 2 years before they can move in. So just another thing to keep in mind when talking to clients. So that's the good news about a 1031 exchange is that you're flexible on what you can sell and buy. But like I said, the IRS, they have to be a pain in the backside somehow. And how they do that is by enforcing very strict timelines in which you must complete your 1031 exchange. So if you're doing a regular 1031 exchange where you sell first and buy second, the clock for the 1031 exchange starts once you close escrow on the property you're selling. So from the closing of the property you're selling, you're going to have 45 calendar days to identify the property or properties that you want to purchase, and a total of 180 days to actually complete your purchase. So 45 days to identify, 180 days to close, and both of those two time frames start once you close on the property you're selling. So you guys might be able to guess which one of those two time frames is harder to meet. And it's usually the 45-day identification period. So usually we don't have clients who have trouble closing within 180 days, but 45 days does come and go pretty quickly. And if there's really one hurdle with completing an exchange, it's usually that identification period. Now, fortunately, you can identify multiple properties. So what does it mean to identify? So basically, once your client closes on their sale, we'll provide them with a form. And within the 45 days, they do have to list the property addresses of the properties that they're identifying. So there are limits on how many properties they can identify. So there's three rules. The first two on this page are, makes up 99.9% of what our clients use. So in order of popularity, the three property rule is the most common way that our clients identify. So basically, what that says is that you can identify up to three different properties. And if you stick to three or less, the total value of those properties doesn't matter. So the three property rule, that's the most common. You can identify up to three properties, and the properties could be any value. But like I spoke about, we have a lot of clients who might want to buy out of state and diversify, and they need to identify more than three properties. So there is what's called the 200% rule, which basically says if you identify four or more properties, you can, but if you identify four or more properties, the value of the properties you identify cannot exceed 2 times your sales price. So if you sell for $1 million and you want to identify four or more properties, the total value of those properties could not exceed $2 million. So you're basically either limited on the number of properties you identify or the total value of the properties you identify. There is what's called the 95% rule or exception, which what that says is that if you don't meet the three property rule and you don't meet the 200% rule, so basically you identify four or more properties and the total value exceeds 2 times your sales price, the 95% rule says that you'd have to acquire at least 95% of those properties or else your exchange would fail. So I always forget to delete that 95% rule. I don't even really ever talk about it or should talk about it just because it never comes up. So just know that your clients are going to be limited to one of these first two rules. I also get questions all the time. Hey, look, can I file for an extension on my 1031 exchange? So the only time the IRS allows for an extension is either for military deployment or a federally declared disaster. So currently speaking, due to the wildfires in Los Angeles, if your client lives in LA County, they could actually extend their time frames, the identification period and the 180 days to October 15th. So there are extensions available if you live in LA County. Those are the only active extensions currently in the state of California. But just know going into an exchange, unless, unforeseen circumstances occur like fires or floods, things of that nature, your clients are going to be stuck to these time frames. So my recommendation, clients always ask me, hey, look, what can I do as far as, helping me meet these guidelines? So I always recommend, once you go into escrow on the property you're selling, start the shopping process, right? I mean, you can go out, you can make offers on properties that you want to buy, before your sale closes. You just have to make them contingent upon your sale closing first. But just know going out earlier, often being proactive is always the best route. The clients that call me on day 40 and they say, "Hey, look, I've just started shopping. What can I do?" Those guys are out of luck. But most of our clients, probably like 85 to 95% of our clients who start early, do complete their exchange. So while these timeframes are daunting potentially, just know it might not be as challenging as it looks. So real quick too, to touch on something that comes up a lot in this marketplace, um, is what's called a reverse 1031 exchange. So oftentimes I'll get clients who will call me and say, "Hey, look, um, I already found a property. I need to close on it. I haven't even listed my current property. Can I buy first and then sell second?" The answer to that is yes. You can do what's called a reverse 1031 exchange. So basically, what you do is you buy first, and then from the closing of the purchase, you'd have 180 days to close on the property you're selling. So that gets a lot of our clients excited, because selling a property in 180 days usually isn't a challenge. So that's the good part is you can do a reverse exchange. The downside to a reverse exchange is they are significantly more complex than a regular 1031 exchange. The reason being is in a reverse exchange, you can't actually be on title to both the property you're buying and the property you're selling at the same time. So if you're doing a reverse exchange, what has to happen is us, as the qualified intermediary, we actually have to form a new LLC. We use that LLC to assign in to the position as the buyer of the new property. So at the closing of the purchase, instead of your client taking title to this property, this LLC that we form would take title at the closing. Your client would then have 180 days to sell their current property. Once they sell their current property, we then transfer them over the property that was purchased. So why this is kind of causes issues potentially is one is the cost. So just to put things in perspective, a regular 1031 exchange where you sell first, buy second, straightforward transaction, it's $1,000. Reverse exchanges typically start at about $6,000 plus the cost of the LLC, which in California is about 800. So cost is something to consider. Having funds is something to consider, right? Because they're not going to have the cash from the property they sold to put down on the property they're buying. So having the money for a down payment is a consideration. And then also third, if they have to get a loan on the purchase, getting the lender on board, and basically agreeing to certain non-recourse language that we require, is also potentially a challenge. So usually speaking, our reverse exchange clients are usually more along the lines of the all cash buyers who have the cash available and can close quickly. But with that being said, we have an entire division set up to handle reverse exchanges. So if that's something your clients need, we could definitely assist. So one more thing I want to touch on as far as what it takes to have a completely tax deferred exchange is, what do you actually have to buy for value wise to defer all of your taxes? So the number the IRS looks at is the gross sales price minus any non-recurring closing costs and commissions. So you can deduct things off your sales price, like, for example, title fees, escrow fees, recording fees, commissions. All of that gets deducted from the sales price, and that's how much you'd have to buy for or hire to defer all of your capital gains taxes. So let's say, for example, you sell for $1 million, you'd have to buy, after closing costs, you have to buy for $1 million or higher to defer all of your taxes. A couple of other things that need to be aware of is one, you do have to reinvest all of the net proceeds as part of the exchange to defer all your taxes. and you need to replace the value of the loan that was paid off. So going back to that previous example, let's say you sell for $1 million. You have 800,000 of cash coming out, and you paid off a $200,000 loan. So what the IRS says is that to defer all your taxes, you have to, buy for $1 million or more. You have to roll all 800,000 of that cash from the sale into the purchase, and you also need to replace the value of that $200,000 loan. So you can do that in two ways. One, which is the most common, you can get another loan on the property you're buying. Or if you have additional cash, like let's say, for example, you had 200,000 of additional cash, you could also, instead of getting a loan, you can, buy the property all cash. So just know that that is what is required to defer all of your capital gains taxes. You can do what's called a partial 1031 exchange. Let's say, for example, you sell for $1 million and you buy for only 900,000. That's still a valid 1031 exchange, but just know that $100,000 difference that you buy down in value by would be subject to capital gains taxes. So that comes up pretty frequently. A lot of our clients, they might want some liquidity, so maybe they take some of the proceeds at the closing of their sale, pay taxes on it, and then reinvest the rest in a 1031 exchange. So those are the three major guidelines as far as completing the exchange, right? You have to sell and buy like kind real estate. You have to do it within the time frames, and to defer all of your taxes, you have to buy for equal to or greater than in value to what you sell. Another requirement is that when you do a 1031 exchange, you have to engage with a qualified intermediary. So that's what I do. So all I do all day is facilitate 1031 exchanges. So my role is pretty simple. Basically, what the IRS says is that if you're doing a 1031 exchange, you have to have a qualified intermediary before the sale closes, draft a set of 1031 documents that have to be signed, and then also we are required to hold your client's funds in between your sale and your subsequent purchase. So, a couple of notes on that. One, I did mention it has to be set up before you close on the property you're selling. So I get calls all the time saying, hey, look, I just found out about a 1031 exchange. We closed yesterday. The funds are still sitting in escrow. And unfortunately, at that point, there's nothing they can do as far as setting up an exchange. So if the exchange is not set up before the closing, your client will have a taxable sale. So that's one thing to keep in mind. Another thing to keep in mind is that, if your clients are shopping around for a qualified intermediary, one thing to know is that, we will be holding their funds in between their sale and their subsequent purchase. So whoever they're working with, you want to make sure that the company, the qualified intermediary, is financially secure. So IPX, that's who I'm with, we are wholly owned by Fidelity National Financial. So the same company that owns Fidelity National Title, Chicago Title, Lawyers Title, Tycor Title, Commonwealth, they also own us as well. So we are the nation's largest and most financially secure 1031 company by a long shot, which is important to know because, believe it or not, our industry is actually federally unregulated as far as what we do with clients' funds, which is pretty ridiculous if you think about it. So just know that security of our clients' funds is our number one priority. So how do we protect our clients' funds? So on each exchange account, we have a $100 million Fidelity bond, a $30 million E&O policy, and also our parent company personally guarantees each and every one of our exchange accounts to up to 50 million bucks. So as far as working with the QI, that is, in my opinion, the number one thing to look at is the financial security. So my role within the company, as I spoke about earlier, is really to assist and guide our clients through the 1031 exchange process. So once again, there's my full contact information. If you have clients thinking about exchanges or have 1031 exchange questions, feel free, direct them my way. I know we went over a lot in kind of a short time period, so I wouldn't expect you to know the ins and outs of 1031 exchanges, and that's what I'm here for. So feel free, anything that you guys need on the 1031 exchange side, let me know. I'm happy to help.
Yeah, real quick, Jordan, that was a phenomenal presentation in a short period of time. I just want to let everyone know that I've referred not only some Alta agents, but some of my, I don't know if you remember, Jordan, but the Brill Hearts when they moved their investment property from Costa Mesa
Sure.
out to
Yeah.
the desert. And so I've used Jordan, referred Jordan. He's an absolute A+ pro player. So I encourage everybody to take his number down, put it into your phone. As Kevin and I always talk about, having good quality professional people in your toolbox is probably one of the best things you can do to separate yourself from other people that don't take the time to at least have a working knowledge of this. And then you can rely on Jordan and his team to help, answer, deeper questions into these, sometimes complex transactions. So, I really appreciate you coming on today, Jordan. This is, something that I think is more and more prevalent, and it's just so important to know.
Yeah, thank you very much, Jordan. Really appreciate your time, buddy.
You got it.
All right, with that said, agents, I know we went over a little bit, but really important stuff, like Bill said. So get out there, make it a great week, a productive week, and we will see you guys next week on the Wednesday webinar, where we'll have a really cool new tool to unload on all of you guys. It's called AdWorks. I know you guys have probably used it in the past, but we're rolling out a corporate version of it for all of our Alta agents. So this is going to be very exciting. So,
we also have a new listing presentation to showcase, right, Kevin?
oh yeah, very, very powerful listing presentation. Shows Alta company stats and the things that you are going to be doing for your sellers. So really cool stuff. I'm excited to bring that stuff out to you guys.
Yeah, looking forward to that too, Kevin. Great webinar today.
Absolutely. All right, guys, have a great day.